Dividend stocks are a great way to boost your investing returns and maybe even beat the market, especially when you can find a company that has a long track record of growing its dividend and an opportunity in front of it to continue that dividend growth as its business generates more cash flow over time. One area of the market that investors continually come back to expecting to find those great returns is infrastructure and infrastructure spending. It's a little bit of an inside joke in DC that Infrastructure Week happens about once a year, but never really results in any massive change. Two things that we know: infrastructure around the world needs to be updated and it needs to be expanded as the global middle class expands. I'm Jason Hall. This is Investing Unscripted. I'm going to break down my favorite infrastructure high yield dividend growth stock. That's a mouthful that I think investors should be looking at buying right now because it trades at some of the best valuations it's traded for in many years. Before we get into the details on this company, though, and the opportunity, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should really check out our special link. It's fool.com/unscripted. It's right there on your screen. Go to that special link and you can get access to The Motley Fool's 10 best stocks to buy right now. They update that on a regular basis. Go check out the offer. I think you'll be glad that you did. Okay, let's get to it. Now, before I break down the stock that I want to talk about, I'm going to share some information for you from the Global Infrastructure Hub, which is part of the G20. It's a G20 funded initiative. So this is 20 of the largest global governments that are funding it. And they're looking at basically the need for infrastructure spending in the largest and fastest developing countries in the world. What I've done here is I've filtered this list down to just the areas that the company I'm going to talk about focuses on, which are transportation, telecommunications. They have a lot in energy, both in transmission and utilities, and also in distribution, telecommunications, data centers, and things like fiber optic and wireless. These are the spending trends right now. Again, so what does this mean? Going from 2007 to 2040 talks about the trends right now and about what is on track to be spent. And we're looking at just under $3.5 trillion in 2040. So if we take this back to this year, the expectation you see is a little over $2.5 trillion is going to be spent on a global basis. You're looking about $71 trillion is what is expected to be spent based on the current trends from 2007 through 2040. So talking about a $15 trillion investment gap between the estimates of what needs to be spent. We move it down, and the need we see is absolutely massive. We're talking about by 2040, the need is going to be to spend over $4.5 trillion compared to the less than $3.5 trillion that is expected to be spent based on the most recent trends. So what's the point? These are very, very large numbers that it's going to take a massive effort from global governments and the private sector to meet these needs. It's modernizing the infrastructure in places like North America, Europe, and also expanding infrastructure in those markets as well, but also thinking about the growth in areas like the entire continent of Africa, where we have some of the fastest growing, youngest populations on earth, different parts of Latin America, China still growing very quickly. There's a lot of infrastructure that just needs to be put in place just to meet the needs of growing populations and also middle-class consumers that want access to consistent, cheap electricity, clean water, and will need transportation to move goods and to move people around. So it is a massive, massive opportunity. What's the stock that I'm going to highlight here? It's Brookfield Infrastructure. There's a good chance if you've followed me for any length of time, you've heard me talk about Brookfield Infrastructure or Brookfield Renewable or one of the other Brookfield Corporation businesses. I love them. And the reason why is right here on this chart, number one. So you see the purple line and you see the Brookfield Infrastructure stock is actually well down. This is including the dividends paid. It's well down from its high price over the past few years. But even with that decline, going back from its early 2008 IPO, trading on the New York Stock Exchange, it has absolutely trounced the S&P 500. The S&P 500 has done really well since that period, generating about an average of 11% a year in total returns. Brookfield Infrastructure has generated an average of over 14% in annualized total returns. So number one, the reason I love it is this is a company in infrastructure that has demonstrated it can make money and make money for investors, grow in value, build a bigger business, return a lot of capital back to shareholders, create real value for the owners of the business as it's deploying these infrastructure assets. So now let me make the case for what the company does and then talk about going forward why I think it's a must buy for investors looking for great dividends, dividend growth, and want to capitalize on the opportunity in the infrastructure space. We'll start here with the four segments that it operates in: utilities, transportation, midstream energy, and data. So as you can see, it has large diversified operations in all of those areas. Over 8 million electricity and natural gas customers, $7 billion in base ratepayers, thousands and thousands of miles or kilometers, however you prefer to measure it, in transmission lines and natural gas pipelines. It is a substantially large utility business. And then you move into the midstream. So again, the utility, this is the customer-facing end of the business. The midstream, this is the logistics of moving energy from where it's produced to get it to where it's consumed. And now we're talking tens of thousands of miles of gathering pipelines and transmission lines, substantial storage facilities, transportation. I skipped over that one to talk about kind of the energy opportunity together. Transportation, it's mostly land-based opportunities. So toll roads, rail operations, terminals, massive amount of infrastructure that it has there. And data, this is an area that it's really moved into in recent years. Telecommunications, fiber optic cable, data centers it's expanded into, even moving into kind of the modern infrastructure, semiconductor manufacturing. Is going to be a large owner of Intel's manufacturing site that they're building to expand into that area. Now, let's talk about global diversity too. I think this is really important. Vast majority of the business, nearly 70% of it, is in the Americas, mostly North America, but Latin America has a substantial footprint there as well. Europe, Asia Pacific as well. Okay, so what exactly do all these businesses do? The best way to think about them is they're like the hidden stuff that makes the modern world work. A lot of these businesses are relatively resistant to recession, foreign currency exchange rates, and resilient where they're not really resistant to recession. So what does that mean? Well, you know what? Moving energy, moving goods, those businesses, when economic downturns happen, they might soften a little bit. They're not going to be as busy. They're not going to generate as much revenue and cash flow. But when the economy recovers, businesses boom. They boost right back to where they were. And all of those businesses have a minimum amount of revenue that they generate. So even when we do go through economic downturns, they're still cash generative businesses. A lot of the other things that it does are really secure across the economic environment. Moving data continues to be a strong business. So we continue to see real strength in so many parts of its business. Now, the opportunity is twofold. Number one, just continue to be an excellent operator as it has, and also win from the massive amount of spending that will continue to flow into infrastructure around the world. We've seen they're able to operate in lots of markets where there is growth happening, where infrastructure needs to be expanded to meet the needs of a burgeoning middle class. And again, just the reality that we need to modernize the infrastructure and update it in so much of the developed world. Already proven that they can operate in pretty much every capital environment and generate good returns for investors. Let's talk about why right now. I have one more chart to share, but before I pull it up, we'll talk about why the stock price has come down. And two things really have happened. Number one, stock price peaked kind of during that bubbly period in late 2021, where the stock market had gone on an exceptional run. Interest rates were effectively zero. And that meant companies that used a lot of debt, like infrastructure companies like Brookfield Infrastructure, had really cheap access to capital. And investors bid so many stocks way, way up to what I think was probably out of value range. They were expensive. And I think that happened with Brookfield Infrastructure. Now, what we've seen is interest rates have gone up a ton since then. As everybody that knows, if you've tried to finance anything, thought about buying a house, you know how much interest rates have made it harder to do that. The market thinks that that's the same. That's going to be a big problem, a big headwind for Brookfield Infrastructure going forward. I don't think that's going to be the case. I think the upside opportunity, the tailwinds are so substantial that they're going to continue to drive the business forward, plus the reality that we know these people know how to allocate capital. They've demonstrated it so well over the years, lots of access to dry powder. It puts them in a position to be a winner and to buy opportunistically when other companies, other infrastructure owners might be struggling and need to raise capital. Specifically right now is this chart. I think the market has overreacted from those peaks in late 2021 and early 2022. And now we look at the dividend yield. I think we can use that for this company as a pretty good proxy for valuation. Over the past decade, it has paid an average yield of about 4.71%. The yield at recent prices is over 5.7%. So it is paying a much higher yield than it has historically because the stock price has fallen so much. I think that's created an awesome opportunity for investors to lock in a really high dividend yield on your cost. See that yield on your cost basis grow as they raise the dividend, that average of 5 to 9% a year, that's their target. Continue to raise it over the long term and continue to profit from the growth of infrastructure spending around the world.